Hello, here is Dr. Abbas Watoli, Assistant Professor, Amal College of Advanced Studies, Nilambur. This video is about equity investing in 2020. This video contains 4 sections. First, an introduction to the world of stock market. Second, the ABC of share trading. Third, about stock simulation games. And finally, about the professional investor. So let's begin. See, as an introduction to the stock market, I would like to talk about 3 things: understanding the market index, analyzing the market returns, and digesting the COVID-19 response. First, understanding the market index. Every day we read in newspapers that sensex has gained 100 points or down by 50 points. Actually, what sensex means? And sensex has crossed its all-time high of 42,000, etc. So what this 42,000 means, or this absolute value of 42,000 means? So just discuss what is meant by sensex. Sensex is the BSC's sensitive index. It is the index of stock market. An index measures changes in the price level. So sensex measures changes in the price level of stock market. An increase in the value of sensex means share prices in the stock market is rising, and similarly a decrease in the value of sensex means share prices in general in stock market is falling. Just like any index, the sensex is also computed with a base value and a base year. For sensex, 100 is the base value and 1979 is the base year. So today sensex is about at 38,128. It means that rupees 100 invested in the year 1979 is worth rupees 38,128 today. So an index is a barometer of the market. By looking at these indices, we can understand the broader sentiments in the market, whether the market is going up or going down. So it acts as a benchmark for measuring the performance of the portfolios and to track the market. Nifty 50 is another popular index. It is the index of National Stock Exchange. It is presently trading at 11,194, and Nifty is calculated with base value of 1,000 and base year of 1995. Sensex is the most popular index in India, but Nifty is the widely used index by the portfolio managers as well as the asset management companies, because Nifty is more diversified and highly professionally maintained index. So let's go to the next slide. So now you have an idea about what is meant by sensex and how to interpret the sensex value and how you can use an index as a measure of market performance. Now we can look at how the market is giving profit over the years. This is the price graph of Nifty 50 index for the last 5 years. So in 2016, Nifty was trading around 8,000. Then later on, by April 2016, there was a fall in Nifty to 7,200 range. Then again it came back, and just like if you look at this index, you can see that there are ups and downs in the market, but generally the trend is positive till March 2020. In March 2020, you can see a sharp fall in the index. It was in connection with the COVID-19 pandamic, and after that market is now in a recovery mode, and after touching an intraday low of 7,600, market now bounced back to 11,194. So if you look at this Nifty's performance, 1 year actually Nifty has fallen, or otherwise minus 0.68 percentage is the return of Nifty for the last 1 year. This is mainly because of this big fall in connection with COVID-19. For 3 years Nifty has given 12% 32% returns, and for 5 years it has given 31.36% return, and for a 10-year period Nifty has given 105.43 percentage. So from this figure you can understand that stock market is giving a decent returns. And also please understand, it is not just the return that attract people to the stock market, but the liquidity, because shares are the most liquid assets in the world. Anytime or any point of time, you can easily convert your shares into cash. That is why more institutions and more people are attracted to the stock market investment. Let's go to the third point as introduction, digesting the COVID-19 response. As of now, we are very much interested to know how the stock market has been responded to this COVID-19 crisis. Actually, the market has fallen drastically in the beginning of the COVID-19 pandemic, but later on it has recovered a much of its fall by this July. So we can see the pictures. In January or February, the Nifty was it's at all-time high around 12,400. Then market has taken a big fall or a crash in the month of March, and then slowly and gradually it started rebounding, and presently it's reached it 11,190. So if you look at these price ranges, you can see that 12,300 was the level in 2020 February, and it came to 7,900 in 2020 March. So it can be translated into a decline of 35.75%. And now in July 2020 it is back to 11,200. So the overall fall from its peak is only 8.9%. From this you can understand that there was a significant fall in the market in the early March, but now the market has recovered, and now from the peak or all-time high level of the Nifty, there is only 8 to 9% corrections in the market. So we can see that even though COVID-19 is world level issue, but the market has somewhat managed to stay at these levels. So we can move to the next section, that is about ABC of share trading. In this section, I would like to discuss about the basics of share trading, how the prices in the shares are determined and how you can buy and sell shares. So this is a snapshot of market breadth for Reliance Industries. This is an older slide. So the Reliance price is showing as 925. And if you see this snapshot or market breadth, you can see that 925.25 level 47 quantity is demanded, and at 925 666 quantity is demanded. Just like this is the bid for shares at different price levels, and this is the offer price for shares 925 and 30 77 quantity is available for sale. 925.35 103 quantity is available. Just like there are many people has placed their selling price. If you want to place a buying order at 920, you can also add that order into the system. Similarly, number of buyers and number of sellers are placing their orders at different prices into the market. When an active order comes to the market, and if it find a match with any existing passive orders, it convert into a trade. For example, now 77 quantity is available for sell at 925.30. If an active buying order comes at 925.3, then that order become a trade, and this 77 quantity will be sold. Just like when more buyers comes in, the price will start increasing. 925.30 shares are sold, then price will become 925.35. And if it also bought somebody else, then it become 925.40. That means if more buying in the market happens, the prices starts increasing. And if more selling happens in the market, prices started decreasing. So this is the way the prices in the markets are start changing for every moment. We can say every fraction of a second there may be changes in the price levels. Actually, market opens at 9 a.m. and there is a pre-open trade for 15 minutes, then 9:15 normal trading will starts and market close at 3:30 p.m. In between that, you can buy shares, as so also you can sell shares. In only in stock market you can have an opportunity to short sell. That means if you think that market may fall intraday, then you can first sell or short sell a share. Then once the share prices has fallen, you can buy it back and make a profit. This kind of trading, we call it as bears. That means you have a bear bearish approach or bearish outlook about the market. Even then you can capitalize using short sale on intraday basis. This is the way people buy shares from the market and sell shares. The simple strategy of trading in stock market is buy at lower levels and sell at higher levels. If you are successful in timing this, then you will be a good profit making trader. At the same time, also remember that there are different type of trading approaches. There is an intraday trading, that means buying and selling within a day. It is very high risky and there is a limited chance of making profit because market is highly volatile and highly predictable in most of the days. The second type of trading is called investment. That is most recommended for any person who want to avoid risk. In long term, most of the shares, that means fundamentally strong shares, will likely to perform or give decent returns. So whenever there is a fall in the market and you can enter into good quality shares and hold it for a somewhat period, and when it achieve your target or reasonably good rate, you can exit and make a profit. This type of long-term commitment of fund in particular shares is called investment, and investment is seems to be the most successful way of making profit from the stock market. And the third one is called swing trading, or otherwise you can call it as positional trading, or otherwise there is a short-term trading in the equity market. This is actually to take the advantages of the price swings or ups and downs in the market. Frequently, you make transactions, not on a daily basis, but you buy shares once it performs or rise significantly, maybe 10 to 15 percentage. You may book your profit and wait for the price to fall again to re-enter into the same shares. So this kind of swing trading is also recommended for people who have time to watch market and understand the reason for the market movements on a short-term basis. So others, if you do not have sufficient time and knowledge to analyze the market, you have to look at the other method of trading called investment. So now there is a third part of the seminar, that is the stock simulation games. This is, I just want to say that before starting the real trading in the stock market, you should try some paper trading. That means you should try some virtual trading platform or like stock market game. Here I am introducing the Dalal Street Investment Journal's Stock Market Challenge or stock market simulation game. Go for it. to study about trading in stock market. You can buy, sell shares as it is like in the market from this platform. Now, the last part is